It's different in the sense that I think some of the tech stocks, which were some of the first to sell off, appear to be bottoming out, both on a relative and an absolute basis. And I think you can take some encouragement from that, since they were one of the first to obviously sell off. But at the end of the day, I mean, we're in front of earnings season, and I think there's an enormous amount of uncertainty. Today's jobs report plays right into that. There's divergences in the data. There's divergences in corporate commentary. Costco gave us something of a positive report today. And so I think you really need to get into earnings season to hear what companies have to say before you can have truly any conviction one way or the other.
Does the jobs report help the soft landing case, or does it embolden the Fed? Because they say, see, the economy's strong enough, we can do this. And then does that increase the risk of a mistake that they go too far?
Sure. In some respects, both, and in some respects, neither. And like a true economist, I'll say on both hands. I mean, clearly the jobs report was stronger than expected. I think the whisper, to the extent that that's a thing anymore, was certainly for a much weaker number than a stronger number. And in that sense, if you're the Fed, you're emboldened by the report that there hasn't been any meaningful slowdown, at least in the labor market. And if you needed any solidification of a 75 basis point hike at the next meeting, whatever Kevin O'Leary says aside, I think that jobs report gave it.
Right. You're alluding to the fact on halftime today, he said they were going to go 50, which
Sure.
He's on an island by himself on that. But this does show that they need to slow the economy down. And that is the risk continued for stocks.
Yeah. But listen, the jobs market aside, you are seeing slowing down in numerous sectors of the economy. I mean, obviously, consumer sentiment is plumbing depths heretofore unseen. The housing market is unquestionably in a slowdown. Some of the manufacturing indices are slowing down. So it's not as if the economy is robust and growing top to bottom. There are pockets of weakness. Just one of those pockets appears thus far not to be the labor market.
CPI next Wednesday.
Sure.
How large does it now loom?
I mean, all the inflation reports loom large right now because obviously the Fed is preoccupied with inflation and everything else is a distant second. We know this from the Fed minutes. We know this from their public commentary that they are willing to slow down the economy to bring down the inflation rate.
You remember what happened last time, right? I mean, there was all this thought going into the CPI. Let's see that it's peaked. And it was exactly the opposite. Yeah. And that was sort of a game changer for the market.
And there is a risk, a probable risk, that this report will, from a headline standpoint, show an even larger year-over-year increase. But as you and I have talked about, the year-over-year numbers we need to dismiss, and you need to focus a lot on those month-to-month numbers. They've been really, really strong lately. And so if you're the Fed, you need to start seeing more normalized rates of increase, something like 1, 2, 3/10, rather than the 5 or 6/10 that we've been seeing.
Does all of the uncertainty that we're speaking about now and all of the issues that are still in front of us make it impossible to say that the bottom was in?
Yeah, I mean, but the most important thing for investors in both equity and credit, or really across markets in general, is that you haven't really seen the full effects of what the Fed has done in the form of risk assets. And yes, the equity market is down 20% or so, down 23% at the low. Yes, credit spreads have blown out. But the way monetary policy works, as we all know, is with long and variable lags. And so to the extent that you're going to see the full effect of what the Fed has done and is likely to continue doing, it's not going to happen for another 3, 4, 5, 6, potentially even longer. And so can the equity market sell off and rally before the Fed even completes its tightening program? I'm not sure that that's the case.
I'm looking at yields as we speak, 307 10-year right now. How much of a risk are yields now, moving higher back 3.25 or so? And that in and of itself is a problem for stocks. And by the way, some of the very stocks that you just cited had rallied off the lows, the ones that were the first to go into the tank, which some of the tech stocks, by the way, ARK, for example, is up 20% this month. The ARK Innovation Fund, of course, of Cathie Wood.
Yeah, listen, I think from an equity standpoint, if the 10-year goes from 307 to 325, is that a problem? No, I don't think that's much of a problem.
You don't think so?
No, I don't think so. That's a de minimis. I think the bigger risk for equities would be if the 10-year went to 250 or 225.
Of course, but you got to stop it at 325 first before you. If you start moving higher towards 3.25, then the conversation is going to be, are we going towards 350?
Well, of course, and then once you get closer to 350, the question is how long until you're at 4. I mean, this is how momentum trades work all across the street.